20,000, 5%. This is the 5% of the for the down payment, minimum down payment required. You need to pay 4%. Not to pay, sorry. You need to add a mortgage insurance premium of 15,200. This will be added to your mortgage mortgage loan amount. So this will end up to 395 200. This is what you need to qualify on based on your household income. Of course, if you're putting more than 5%, let's say 10 or 15, that premium, mortgage insurance premiums will go down. Um, I would say between 3.1 and 2.4%, so respectively. So on the 10%, you would pay 3.1% of the loan amount as a mortgage insurance premium, and on the 15, it's about 2.4%. When you're paying 20% down or more, you don't need mortgage insurance premium because you have enough equity in the property that protects, like, the lender as an investment to invest, like, to give you the money, the mortgage amount. Okay, so now we're going to talk about how we can invest a 5% as an owner occupied property, and you can get over these. You can go over the regular mortgages, like the insured mortgages premium that we're talking about. كيف رح نقدر ناخذ these properties with the better scenarios, and especially for people who does have only 5% down. So this program called like A12 Mortgage Co-Equity Program. This is an agreement happens between a real estate investment property called Our Borough and A12 Mortgage, which is our brokerage, and we are the only brokerage that we have did this agreement between this Our Borough, the Real Estate Mortgage Investment Corporation, and with a bank, which is right now is only Equitable Bank. So and goes through our brokerage to do this kind of deal. Okay, so Mortgage is a preferred brokerage partner of Our Borough. This partnership has provided our clients with a chance to reach their home ownership goal through a co-ownership. Okay. So while your client is living in their home, Our Borough offers programs and services to help preserve and increase their home's value, so that together your client and Our Borough can share in the profit when it is sold. Your client can choose to sell their home or offer to buy out Our Borough shares based on fair market value at any time during the 30 years period. So this co-ownership is this entity, which is Our Borough. They're gonna be they're not gonna be on title, okay, and they're not gonna put a lien on the property, but they're gonna invest in the property with you. So you can put as minimum as 5%, and they can contribute up to 15% to make the 20% altogether. So this deal have to always be under the 20% down payment. So you can share at the same time, and instead of, let's say, for example, 5%, you can go up to 10% or even 15%, and Our Borough can give you another 5% to reach the 20%. Okay, so why buyers choose to Our Borough their homes with you? They can get into the home they want sooner. Diversify, sorry, their investment savings. Save money on closing cost. I will get to that point. Access homeowner perks like complimentary home maintenance checkups or financial support on a rainy day. We can go to that as well. Work with a fully aligned partner that only succeeds as an investor when the buyer succeeds as a homeowner. So these are borrower entity, they only going to succeed when you succeed. So it's like they are a silent investor with you, and they only that if the property appreciated in value, they share that profit. If the property depreciating in value, let's say loss of a lot, you need to sell it before and the sell with loss. Both of you guys are taking that loss. Okay, so what's the requirements in order for you to join that program? First of all, you have to be either Canadian citizen or permanent resident. If you are, let's say, for example, on your PR is not like ready yet, like you are, you have a work permit or you're a refugee, this program is not fit for you at the moment. You have to make sure that you have a PR in order to submit for such a program. Okay, so you're looking to buy a home in the GTA. So it's expanding, like we have, believe, London and Oshawa. I have a list of these locations. I will share it with you. Uh, and they're purchasing the home as a primary residence. This is very important. So you cannot purchase that property as a rental property. You might want to make sure that this property you're gonna own, like you're gonna be owner occupied the property. And at least you're going to invest 5%. This is the minimum you have to put down of the home value towards your down payment at the time of purchase. Okay, and you have to qualify for the mortgage amount needed to buy a home with one of our approved lenders. Right now, as I said in the beginning, it's only Equitable Bank. In the future, it might be expanded to other lenders, but now the only approved bank is Equitable Bank. And you can sell your home, like this ownership is gonna like, or this agreement or this investment is gonna be for 30 years. A couple months ago, they just recently changed. It was only 10 years. Now they changed it to 30 years to accommodate the whole amortization period, which is the 30 years amortization. Okay, right now, how it works, okay, buying their home. Your client can start submitting an application and pre-qualifying with A12 mortgage. So we're gonna send a pre-approval letter to our borrower, and then after that, we're gonna do our borrower gonna do an interview with you guys, and then we start the process of the mortgage process to get to get you as a regular mortgage to get approved and satisfy all the conditions, and then we close. They advance the money to the lawyer, and the deal will be closed. Our borrow equity split will be finalized once an offer is made on a property. Of course, so we have a property, there is an offer, then each one share will be advised, or like will be, let's say, for example, you put a 5% and our borrower is putting 15%. So these shares will be respectively put in writing in an agreement. We have an example here. So if you are purchasing a home of $1 million, so 20%, 20% is coming as a 200,000, 150,000 coming from our borrower as a contribution, or 50,000 your contribution as a client. So this will as a percentage, this will be a 15%, and this one is 5%. The total mortgage would be 800,000. This is what we need. So 75. Okay, so 75% is the percentage of that 150 from the 200,000, and 25% is your percentage of the 50,000 contribution from the 200,000. Ahmed, any questions so far?
We are good. It's okay.
Good. Okay. The percentage of the okay, so percentage of the down payment where our client and our borrower each contribute translates into the percentage of equity or ownership that both your client and our borrower will have in the home. This is referred to as the equity split. Okay, so the co-owing with our borrower is like having a silent partner that's got your client back on all things related to their most valuable investment. While in the home, your client can make minor changes entirely at their own discretion, while major updates may qualify for our borrower's renovation credit program. Yani, so for example, if you're doing any minor changes, there is there is no need for to get an approval from our borrower. But if you're doing like a major change, let's say you're doing changes, wall changes, or like major renovation, then you need to take the permission from our borrower because they are investors with you. So you want to make sure their investment is in the right place and they are protecting their investment. And as your client partner, our borrower offers a complimentary home maintenance service to help protect the home value. So this is a complimentary home maintenance service. Let's say every twice a year, they come and check the property, and if there is any problems, and so they can advise you about that. This is free of charge. Sometimes they also do filters, change filters for the furnace, and any other small minor, maintenance services that they can provide. Okay, so when you're selling your home, the client and our borrower can only co-own the home together for up to 10 years. This is incorrect. This is 30 years now. This is old. Your client is always free to sell the home or make an offer to buy our borrower's share. So at any time, there is no restrictions. You can you can sell the property or you can buy them out. So there is no restriction on that. When the home is sold, your client's mortgage principal payment will be returned to themselves before our borrower divides the remaining proceeds according to your client and our borrower's ownership shares in the home. So when you're paying the mortgage, the payment of the mortgage, you're going to be responsible for it. You're going to pay principal and interest, and that accumulation of the interest, it belongs to you. So this, when they do the share split at the end, this will be deducted, goes to you, and then they take the rest of the money and based on the down payment share, it will be splitted accordingly. Now your client is ready to go out and buy their next home. All right. So the most important part is, of course, when selling the home. Uh, so let's say, for example, the same property we used before, the property sale price was 1,500,000, and so the remaining mortgage on that property is 700,000. Okay, so the net proceeds is 800,000. You see here the 100,000 return of mortgage principal. This is will be deducted because it's going to have to go to you. So the net appreciation in value is 700K. Okay. Our borrow was their share because they put 15%, was 75, and your share was 25% from the contribution in the down payment. So that will reflect to a 525,000 to our borrow and 175 to you, plus the 100,000, which is the principal amount that you put, with a total of 275,000. This will be returned back to you. So your client will walk away with their mortgage payments plus the appreciation value of their original down payment. And just like that, your client, our borrower, will receive the appreciated value of their down payment contribution. The return our borrower earns on their initial down payment contribution is always identical to what your client earns on theirs. Key reminders. Okay, our borrower is not registered on title, as I said before. Does not place any liens or charges against the property. Our borrower beneficial interest is held in trust by the home buyer. Our borrower restricts the property to ensure the home cannot be sold, refinanced without our borrower consent. Of course, they want to protect their investment. The home buyer can offer to buy out our borrower's share or sell the home at any time. Yeah, that's self-explanatory. Agreement is in effect for 30 years. So they can be co-owners with you for 30 years, but the recommendation is always not to stay more than 10 years with them, because you don't need, like, the property is going to appreciate in value, hopefully. So we don't want to take the big chunk of that investment. So it's better is either to refinance the property or to manage to get them out, to buy them out as soon as possible.
Safe.
Yes, Ahmed.
So, in regarding this 30 years, so why
Yes.
we need to clarify why 30? 30 because of the mortgage is maximum 30 years, yeah?
Yes, the mortgage is, well, yes, on most of the cases, the mortgages here in Canada, we have the 25 years and the 30 years. These are the popular two mortgage terms. So when you put 20%, you qualify for the 30 years amortization. And this will match, yes. So what did our borrower did is to match that 30 years amortization. So we don't need to get, like, you need to give them their money or sell the property or refinance the property
So it's every.
earlier.
Oh, okay. So
No.
if it's the term is 25 years, it will be go with 25 years.
Well, the term, like on this program, we don't have a 25 years amortization, only
So
30 years.
because we're 20%?
Yes. Yes, 20% and using equitable bank. Maybe in the future, if we have other big lenders or one, like if we're going to have one of the big banks to get enrolled in the program, then might be the scenario. But for now, this is the only bank that's we have agreement, or our borrower and like all the government entities have an agreement on, is with Equitable Bank.
Okay.
Does this answer the question?
Yes. Yes, thank you.
Okay. Good. Thank you. No, that's good. All right. So if you guys have any questions, please, let's read I believe the text. Ahmed, help me with that if there is anything that.
Okay. If someone doesn't want to type and want to speak, I can open the mic for them. So just.
Sure. But let's answer the people first, Ahmed, before opening the mic. We have Mustafa here. So selling the property within 30 years is a must, right? And this is where our borrower makes the profit. Did I understand right? Yes, Mustafa. So the whole amortization for the mortgage is, the mortgage term is 30 years. So we're matching that. Our borrower is matching that 30 years amortization. So if you have like on the 30th of term, like you are ending up with no mortgage, because you're the more you go in the years, the less mortgage principal will stay. So when you reach 30 years, you're almost like you're done with your mortgage. You're going to pay off the property. But our recommendation is to get out of that before, because if the property, let's say in 30 years, is you bought it for $1 million and it's worth $6 million in 30 years from now, you don't want to give that big amount to the investors or our borrower. So that's why we recommend that you get out of that by refinancing or paying them off, giving them an offer based on the fair market value of the property at that time when you want to sell or you want to buy them out. Based on the fair market value, we're going to decide. They decide what's the share and how much they need from you to buy them out.
Okay, thank you.
Um,
So I open the mic for you, Ahmed, if you want to ask.
Ahmed, you have to enable the mic.
Yeah, I enable the mics for Ahmed. You want to?
No, yes, it was who I have to enable the mic to.
I
Maybe
already
Ishtar.
enabled. Yeah. Okay.
Yeah, he is. He's on.
Whoa, sorry about that. I was talking.
No worries, no worries.
Thank you
Yes,
so
Ahmed.
much for the presentation you made and the efforts over here. Thank you
Yes,
so much, Mr.
thank you.
Ahmed.
You're
So I have a question to you, sir. That let's say that I have like 100K per year, okay, and I apply for mortgage, and they said that the maximum I can get like 500. Okay,
Yes, yes,
okay, perfect. So if I have like a house to buy within 700K, I wouldn't be able to. So if I put like a down payment for 20%, me and our borrower altogether, it will be
yes,
20%.
yes,
So am I able
yes.
to purchase this house?
Yeah, it depends on the total household income, and of course, your buying value would be higher because when you're using Equitable Bank, their ratios are different than the bank. They're more uh, they give you a higher ratio, so that means they give you a higher mortgage loan amount. Plus, the other advantage is taking the 30 years amortization, and instead of the 25 years amortization with the insured deal when you put a 50,000 down. That's another advantage. So there is advantages of that program, but again, you have to understand that this, if you have like, you need to qualify income wise. Like what you're qualifying would be much better when it comes to that program than to go with an insured deal with the insurance premium, a mortgage premium, and the 25 years amortization. Yes, of course, there's a better advantage. And if you want to run a scenario, I can run a scenario for you. You can contact me, and I will give you like a small breakdown, and we'll take it from there. I will give you the maximum loan amount that you can purchase.
But for sure, Safets will help if he will by himself only. If he can purchase amount maximum 550 with the program, he can maybe push for around 700. It depends on the numbers, yeah, plus or
It
minus.
depends on the household income. So
Ah,
I have to look into the deal in general, like from let's say from income perspective, from debts perspective, we have to look into that in general. But yes, if you're going to ask me a question, would that program qualify me to for a higher purchase? Yes, for sure. But again, it depends. It's a case by case. I don't know how much higher you can go if you have lots of debts. This is all affecting, and if there is a, let's say, a condo fee, a property tax, it's all these variables will affect how we're looking into the deal.
okay, great. Thank you, Saif.
Right, perfect. Great.
If
Thank
that
you so much.
answers the question. Yes. You're welcome, Ahmed.
So, any other question for anyone?
Mustafa wants to ask a question.
Yeah, sure. Let me open. Go ahead.
Yeah, also I want thank you for this presentation. I have some question. First, it's about like when you said there is when I do some major renovation, I have to take
Yes.
like the approval from our borough first. Okay, and
Yes.
they will share with me in the cost of this renovation.
That's a really good question. Thanks for bringing that to our attention. So the renovation cost. So let's say, for example, the property, let's say you're doing the basement, for example,
Yeah.
and the basement cost is 50,000.
Mhm.
And that when we are doing the like the fair market value, let's say when we get an appraisal to check the property after the property appreciated in value, and that appreciation that just the basement gave in from the 50,000, you made 100,000 extra
Mhm.
based on our borrow policies, and they will credit you that amount. So they will deduct that portion that you paid it already, like the 50,000.
Mhm.
It's and they will credit you even more than that because there is an appreciation in the because of that investment you did.
So
But
let's
this,
say, like the examples
yes,
that you are showing now. So
yes,
if we will say, like 800 minus the 100K minus
yes,
the 50,000 K,
yes,
right?
hmm yes. So the appreciation would be, let's say, for example, for this case, it's going to be a little bit different because we're going to add
Mhm.
instead of uh, the sale price is going to get to 1.6 instead of 1.5 because of the
The
basement.
renovation.
Yes,
Okay.
because of the renovation. So based on that, then you're gonna have ending up with, let's say we're on the 700K, just to
Mhm.
make it
Mhm.
simple. Yeah. So again, they're gonna credit you back these whatever you paid for the renovation, and the split that would be uh, like contributed based on the amount you put. Well, sometimes they credit you 100%. So it's a case by case basis, but
Yeah.
again, they're not here to take advantage.
Mhm.
They want to get advantage of the appreciation in value, and they take
Okay.
their percentage. But anything you do to make their investment
Value. Yeah.
investment,
To increase the value of the house.
Yeah.
yes, they will love to give you back for that. And yeah, but again, sometimes bringing that to thanks for bringing that to attention. Some people asking they can give you a credit.
Yeah,
For,
this is what I was about to ask also. They will be doing a credit right away, or when we will be selling the house.
you are they know when you're selling the house, you're going to be
Okay.
responsible for getting the loan or like how you're going to pay for that renovation, but they're going
Okay.
to credit you back at the final state, like when you're
Final.
yes, when you're going
Okay.
to buy them out or selling the property. But again, these are like more like detailed information that we have with Arbor. They
Yeah.
have like about 3 months of mortgage payment
Mhm.
hold. We can use that towards the renovation.
Any renovation. Okay.
Yes, that. But you will need to like submit a request for that, and they might like give you an offer for that. The 3 months, the 3 months mortgage, whatever it is. Let's say,
Okay.
for example, it's 3,500. Or let's say to make it easier, $3,000 mortgage payment. Then
Mhm.
9,000 might be credited for you as for that renovation.
Yeah. Can I
Okay.
add, Saif?
Yes,
Mhm.
totally.
Yeah. So everything you need to do it as a renovation, small or yeah, small
Or
things
major.
you can go directly if
Yeah.
you make any small changes, paint in the house, change some small items. You don't need to go
Get
for
approval. Yeah.
yeah,
Yeah,
yeah.
but if it's a
So,
structural,
yeah,
if
only
it's
the big item.
structural,
We're talking about basement. We're talking about upgrading windows. We're talking about roof. These big
Roof. Yeah.
items that will
Mhm.
help in add equity to the house. So you need to approve them, approve this from them,
Get approval. Yeah.
we get
yeah,
approval. So, and if, for example, if they didn't agree, but still you have, it's your house, you can do it. No one will prevent you to do it. But the good thing in this program regarding if you got a house nowadays, people, a lot of people because of the mortgage high little bit, they thinking, okay, I'll go for a house and maybe basement is not finished. I will finish the basement, and I don't need it. I will
Rented.
market for rent. So
yeah,
okay, they can So you do the application with them, they agree, okay, we'll do the renovation. You will pay it right now. For the rent gain or the monthly what you get from rent, this is yours.
Yes.
They will not share it with you. 100% yours.
Yeah. So
Mhm.
let's say, for example, we did a basement to, let's say we did a legal basement and you rent it out. It's 100% your money. They don't
Okay.
share it with you.
Sharing with me. Yeah.
Yes.
No, there
But
is
the
no
most
sharing.
important part, you need not the whole house. You cannot rent the whole house, as I said. It's have to be owner occupied. You have to be in the property. But as the basement, yes, you can rent it out.
Okay. Another question. So now they will not share with me in any, like the closing fees, like lawyer fees,
Good point.
anything like that.
Yes,
Uh,
for sure. So the main part, it's going to be because it's like they're a silent partner, but they have, like, for example, for the land transfer tax.
Mm-hmm.
For the land transfer tax, you would pay your own percentage of the down payment, and
Mhm.
our borrower is going to contribute with the, let's say they contribute with the 15%, which is equals to 75% of the thing. So they're going to contribute of 75% of the land transfer tax.
Land transfer. Oh, very
Yes.
good.
uh,
So
let-
this one is this is upfront. So on the closing, this is what
Yeah.
they're going to advance on top of the down
Very
payment.
good.
Yes.
So when I say, like, for example, to make it easy, like for everyone to understand. So if I'm paying, like a land transfer, for example, like 10,000,
Mhm.
so they will be paying 15% from this 10,000. I will be paying 5%.
Correct. In a percentage wise, yes, correct.
Okay.
Correct. And
Okay.
if you're the one more thing to bring to attention,
Uh-huh.
the 5% you're contributed on the land transfer tax, if you are a first-time home buyer,
Yeah.
then the the first-time home buyer rebate, it's about 4,000 if it's outside the
Yeah.
GTA.
Mhm.
That this 4,000 rebate is going to go only on your portion, not their portion.
Oh,
Well,
very good. Very
okay,
good.
so this is on your
This
portion.
is a good privilege also.
Well, it's
yeah,
you're gonna see, like, sometimes you're gonna pay nothing based on the
Mhm.
purchase price
Yeah.
because of the percentage of contribution on in the down payment.
Yeah, this will encourage me, like to pay more in the down payment, because I know that, like I will be saving some, like percentage in the closing fees. Because usually when we go, like and buy a house, when you do your calculation, you put into consideration the down payment and the closing fees. Because some people, like they forgot about the closing fees, which is,
Correct. The bank,
like a good amount of money.
yes. Usually the bank, when they calculate it for us, like, they're not gonna use the calculator and calculate that because it's approximate number. We usually calculate 1.5% of the purchase price as a
Okay.
closing cost. So
Okay.
just keep
Okay.
it as a rule, a simple rule, but it might be
Yeah.
less and it might be more than that. It depends on the situation of the property and if it's from a builder or a resale property. Um, uh, oh, and by the way, on a pre-construction right now, it's not available. Only for
Yeah.
resale property.
For resale. Yeah. Okay.
Yeah, yeah.
Last question.
Mhm.
For now, when you are saying, like we will be selling the house, okay, by the
Correct.
end. So now there will be also another cost, which will be, like for example, the percentage for the real estate who will be selling the house. There will be also another, like closing fees to, like to transfer also, like the house, and like some fees for selling also the house. So
Okay.
at this time it will be deducted also before, like splitting, like the net appreciation.
Yes, correct. You're bringing, like, two very good questions, Mustafa. Thank you.
No problem.
Okay, so yes, so the first thing is going to be paid is first of all, we're going to pay the lender. You're going to pay
Okay.
the lender back,
Yeah.
the bank,
Yeah.
and
Mhm.
then any third parties. So the third parties would be, let's say, real estate,
Real
lawyer,
estate.
all these commission, and the net,
Mhm.
like the net what we discussed is here. Let's say for this one here is the net
Mhm.
appreciation. That's what we need to be split it based on the contribution and the percentage.
Okay, so we'll be deducting also the third party fees.
Correct. Yes, 100%. Yes. And
Okay,
sometimes, and sorry to interrupt,
uh-huh.
sometimes there is more of the closing fees to be deducted as well. But it's not, it depends on case by case as well. But these are the main subjects or percentages that to be deducted.
Okay, okay.
IT.
Another, I'm sorry, like I got
No, no,
another
you're asking very
question.
good questions, Mustafa.
Yeah, yeah, I got another question. Like you are saying that I can, like buy the share of our borrow at any time,
Yes.
after 10 years, or it can be also before 10 years.
Uh, no, no, no. Anytime, like the next day.
Anytime, even after 1 year.
Yeah, even after 1 year, of course. So this
Okay.
program, like you have to understand, like
Mhm.
if you get out of the program as soon as possible, that
Mhm.
would be better for you.
Yeah, I can hear you, but like they are an investor and they want like to like earn some money or gain some money. So I'm saying like nowadays, for example, some like the prices dropped a little bit, like
Mhm.
of the houses,
Yes.
they dropped a little bit. So if, for example, like I bought like the house now, in 2 years there is a crisis, so like the prices got down, and at this time like I want to benefit from this crisis, like, and buy their share. So it will be now, like the amount will be less than the amount that they paid, like in initially. So I don't know if I
Well,
no,
yeah,
it's
I understand what you're saying. Uh,
yeah.
but
So if for example, like I bought this house now for 700K,
and
and after 2 years it came to 600K, for example.
yes, okay. So yes, it should, like based on their policies, it should be like. And you, let's say for example, if you purchasing, like if there is a problem, you need to get to buy them out as soon as possible, or you buy them
Yeah.
out for the 2 years, like when the crisis is, you're gonna give them an offer. So,
Okay.
and they will take into consideration the fair market value of the property.
So they will not refuse. They said no, like
They
it's
they should not. They should not.
okay. So they
Yeah.
will not put any restriction or anything, like they said. When they said anytime, it mean anytime I'm willing to buy their share, I can do.
Listen, like when we're doing the pre-approval for you, you're gonna have an interview with them, and you can ask
Okay.
them all these questions,
Okay. Very
all
good.
these
Very
detailed
good.
questions, so to make your peace of mind.
Yes.
Because I'm here like I'm as like a mortgage agent.
Mortgage
I'm
agent. Yeah.
red. I'm like an entity with a brokerage. So these
Yes. Yes.
investors, I'm trying to get as much as information I can get. But
Very good.
again, you would be able to ask them any
To ask
questions
them
read
before
all their
going. Yeah.
process. So we want to make
Okay.
sure that you are in the right place.
Okay. This is good, and I will get like your information from Ahmed, so I can do like uh, a pre what we say, like a pre-appraisal
Pre-qualification or
with you,
Qualification,
like
yeah.
a
yes,
pre-evaluations to see, like
yes,
Yeah.
sure
everything,
thing,
yeah, before.
sure
Okay,
thing.
thank you so much. Thank
You're
you.
welcome, Mustafa. Thanks for
Appreciate it.
asking the questions.
Thank you.
Really valuable.
Appreciate it.
Thank you.
Thank you.
So
Thank you.
I the system for for investor always should be win-win situation. So it's when you buy a house, it's you are not selling this house after 2 months or 6 months or something, because you will lose money, because the expenses for buying and for selling the house will not cover this. So the investors knows that the in Canada, you are, or Ontario, you need most of the people staying at least 5 years in the house to so
So
the
they
equity for the house will increase, and so the exception. Some exception can happen, but for sure, as an investor, he studied this risk. Yeah, so it's. I think it should be win-win situation.
Yes.
Okay.
Exactly. They're
So
taking that into the risk. Like they're
yeah, so it was a question from Ahmed regarding this is first time home buyer 4K. So this will be calculated after the discount or no the share. So as Saif said, so it's, if it's the tax is 15,000, for example, so it will be 5 and 10. It will be divided before you will take the discount. So your share for the land transfer tax is 5,000. You will take 4K, for example, from this 5, you will pay only 1,000. Is this okay?
Yes.
Yeah.
Yeah.
Okay. So any other question? You're welcome.
Welcome, Ahmed. If you have any questions later, you can ask Ahmed, and I can, Ahmed share my information with the clients that joined, and I'm more than happy to answer all their questions. Working with them for like pre-qualification, show them the numbers, these approximate numbers that they need to look into it. Show them the difference between if they put only 5% or even like whatever their share they want to invest less than 20%. Show them that comparing apple to apple, the same property, for example, same scenario, between using that program and the new program and using the insured deal, how that makes a difference for you. And the one more thing that we need to bring to your attention, the minimum purchase price is 550,000. So Arbor will only join if the minimum purchase price is 550,000, and it can go up to 2.5 million. So the limit, there's a good limit, but make sure it's going to be the purchase price is not going to be less than 550.
Okay, great. I want to clarify something also. If you, for example, you approach Saif and ask him to evaluate your income and what number you can purchase with. So I believe Saif, he will advise you. He can tell you it's okay. This you can go with this program even if you are if you have option to go with other standard lenders without the program. I believe Saif can help you in this. Yes.
Yes, I have like access to over 50 lenders, most of them A and also B and C lenders, which you call the private. So it's not like this program. This is one of the niche programs or the unique programs that our brokerage offer. But we have access to every single lender here in Canada, Ontario. Even if you want to purchase a property somewhere else, like in Canada, we're here to help as well. It's not like we're an Ontario-based brokerage.
Okay,
Yeah.
great. So also I want to give a quick brief about the market right now. Now it's everyone knows the prices dropped for last year until last month. The correction already happened. So the prices of today, it's almost the prices 1 year back. So this increase in prices now corrected and now become in the level of 1 year back or 1.5 year. What happened now because of low inventory in the market start to going up again, and we can see multiple offer on in some properties. Also, the builders now, they have some issues. They can't. It's a limited project, and they are, because the builder they increased the price for the last 2 years, so they have problems. So sometimes now you find a house 2-3 years old or 5 years old, its price is less than the builder provide. It was good amount. So, but some builders, they can't drop the price because they already sold the phase one or something like this. They can't reduce the price again. So so I believe this is a good time to be in market. And the interest rate, Safe, what's the expectation for interest rate in coming months?
Well, for the last like couple 2 days, like some of the major banks that they're already regarding a fixed rate, and they lowered it down a little bit of 0.1 approximately average. Starting rate with the banks, I believe it around 4.59, 4.69 for fixed rate for 5 years. But it depends on your scenario in your case. It depends on the deal. This is an insured deal, and not everybody can qualify for that. When it comes to what we're offering in that program, then the rates is going to be a little bit higher than this, and based on 1-2 years. And we have we're going to see if there is a plan, there is enough equity to buy out our borrow. So what we're doing for you is we want you to jump into the market in a good market, and then after that we plan with you step by step until you can buy out our borrow, refinance the property, and coming to a better program with one of the lenders. So this is just a transitory solution, but you can stay with them for as much as you want, as up to 30 years for such a program. And we're always trying to help you understand jumping into the market as soon as you can, especially in a good when everybody's afraid of jumping into the market, would be a good strategy.
Okay, great. Thank you, Saif. So before we're closing, any other questions?
You're welcome, Ahmed.
Okay, great.
Mustafa.
Okay. Thank you, everyone. Any question you found later or anything, please let me know. And I will send you also the contact for Saif. Thank you.
Thank you. Thanks, Ahmed, for inviting me.
Thank you.
Shukran.